So as day traders, as the retail market, as we fall in the retail sector, we mainly deal with liquidity providers and foreign exchange brokers in order to participate fully in the foreign exchange market. So these are two participants that we are going to look upon them and go a bit in details. So who are the liquidity providers? Liquidity providers are the international banks. So the ones in the interbank market. So these provide the service of being a buyer and a seller of exchange rates in various currencies that are traded in the Forex market. The international banks are the ones that provide us with the prices for buying and selling. The exchange rates that you see on the computer screens, the exchange rates that you see when you go to do a Forex transaction, maybe as a tourist or maybe as a businessman, as an investor, you go and do a foreign exchange transaction at a bank, you find there's a price for buying and selling foreign exchange currency. So a foreign currency. So the quote that you see is set there by the dealers that are in the banks. So in the foreign exchange market that we are trading, that we use our phones, we use our computers, the costs that we see are the costs that come from the international banks. These are the liquidity providers that are available in the banks. So the range of movement of currencies in the Forex market is quite small. You can see that there is a very high volume of trading per day. Like the daily turnover is around $7.5 trillion. But then the movement of prices in the foreign exchange market, you can say if it has moved a lot in a day, you would only see a 2% change in price. That is contrary to the stock market or to the crypto market, where you can see a 20% move in the market for a certain share in a day. In the crypto market, is overwhelming. You can see even a 400%, 1000% move in a day. But the volume that is needed to move prices in these markets, like the crypto market or the stock market, is small compared to the amount of money required to be able to buy or sell these currencies. So a large amount of money is required to be able to buy and sell these currencies. So the role of liquidity providers is to put in place conditions that ensure that the stability of prices of currency pairs is there, and they do that by taking buy or sell position in these currencies. And these positions can be sold off to other lesser trading entities, such as the market maker brokers, because we also have brokers who are market makers. So these liquidity providers are also called market makers, are also called dealers in the banks. So a market maker is there to buy or sell an asset at a public quoted price on a regular and continuous basis. So that is the role of a market maker. In this manner, market makers enhance the architecture of the foreign exchange market in terms of trade execution, ensuring that there is always a buyer or a seller to fulfill the trade orders of the retail clients at any point in time. So at any point in time, when you put your buy order or a sell order, it is immediately filled. That means the market is highly liquid. That means this market is not like any other market in the financial markets, because if you trade maybe the stock market, perhaps in any stock market, which is publicly available, like here in Tanzania, we have the Dar es Salaam Stock Exchange. For example, you want to buy or to purchase shares from a certain company, which is publicly quoted. When you put in your order, like I want to buy this amount of shares through a broker, there has to be a seller who is holding those shares willing to sell at the price that you are willing to buy in order for that order to be filled. So sometimes in shares that are less frequently traded, you would find your order would be there and not filled for about a week, 2 weeks, even 2 months. But with the presence of market makers, the market makers are there on the other side. There is always a buyer, there's always a seller to fulfill these trade orders. That is why when you put an order in the Forex market, when you buy, it is immediately filled. When you sell, it is immediately filled. So how do market makers make money out of this? Uh, they receive money from the price differential between the ask price and the bid price of a currency pair. So they have the buying price and the selling price. And the difference between the buying price and the selling price is what we call their margin, their profit. It is known as the spread, and it is taken from the accounts of a retail trader as soon as their trade orders are executed. So the spread is their profit. And by acting as counterparties, they receive profit from losing trades in the market. So your loss is also their gain. So that's how they make money.